Win, why energy in 2020?
Well, you know, I got to start with a caveat. You never wake up in the morning wishing you have a chance to buy an energy company. You know, I mean, at Oakmark, we're comparing all stocks against each other. We're not just looking at a particular sector. So we're comparing Apache to Microsoft to Merck. Energy has been a significant laggard, and more importantly, there's been a huge amount of underinvestment from a supply perspective. The price of oil is up 100% since 2016. The energy indices are down since then. We're basically seeing the market give us these companies at a discount to the runoff value of their existing fields.
And so within the industry, then, what attracts you the most in terms of the theme you just set out?
Well, so this is an industry that has a history of bad capital allocation. So one of the first things, you know, given our holding period is 4 to 7 years, the way these companies deploy their cash flows is really important to the investment thesis. So we have to find management teams and boards of directors that think like portfolio managers. It's harder in this industry than in a number of industries. So that's the first criteria, and, you know, it's a disqualifier if they don't. We're looking for companies with oil exposure. We think that's the part of the market that's likely to inflect. We think the clearing price of oil is going to prove to be higher than it currently is, and there's some companies with a lot of leverage to that.
So with energy stocks coming off, 2019, where they were among the worst performers this year, what are some of the individual names that you're focused on for 2020 in particular?
So some of the stocks that we like include Diamondback, Apache, EOG. These are companies run by excellent CEOs. They're essentially growing their oil production double digits, with the stocks having a mid-single-digit cash flow yield right now, despite below normal oil prices. So even if oil prices stayed flat, these companies would probably produce double-digit shareholder returns. But we think the amount of supply that's come out of the industry, the rig counts declining the way they have, the complete collapse in offshore is going to lead to an environment where the price of oil is actually, $10 or so higher, and they have a lot of leverage to that in their income statements.
Hey, Win, Journal did a piece this week about shale and banks tightening their credit lines, quoted some people thinking they might cut revolvers by 10%, largely affecting the smaller players. You buy that?
Yeah, I mean, that's the part of the cycle that we're in. And if you look at, you guys know how investing works. If you look at every investor who you've heard of who's had a successful 40-year career, they frequently deploy capital into industries where the capital markets have closed to them. Right now, we think that if you can find oil and gas companies with good management teams and balance sheets that will ensure survivability through potentially a prolonged downturn, because we don't know when the timing is going to be on this turn, you're getting paid pretty handsomely in terms of discount to value right now.
You talked about oil not being at a normal price. Why isn't this a normal price? And I heard your belief that you think it will go up this year. Is this just a play then on your part on your belief that oil prices will increase by $10?
So we think at the current stock prices, the companies that we invest in, like a Diamondback or an EOG, essentially could run off their existing reserves without growth CapEx, and we would end up doing fine. The increase in oil price would provide a lot of upside to our valuations. The last quarter showed an increase in demand for oil by 1.1 billion barrels a day, at the same time that the reserve replacement index is at its lowest level in 20 years. In a cyclical industry, when capital stops being deployed to it, it looks bad for a while, but then suddenly that incremental barrel is demanded by the market, and the price goes to the cost to get that out of the ground.
Right. So you don't think the Permian production is going to increase from here in 2020?
The technology there has been amazing. The production growth has been phenomenal. It's been one reason why this has been a terrible sector. But if you look at the decline rates of these wells and you look at the amount of capital that's required to maintain production at these levels, and you look at what you guys just said about how capital is getting cut off from this industry, it's difficult to see how you get the type of step function increase in supply that you've seen the past couple years.